this current market fall. But moving on, Varun Lohchab from HDFC Securities joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much, Varun, for joining us. Well, we are in the midst of what is essentially a very sharp correction. The Nifty has given up significant gains from the recent highs. Mid-cap and small-cap indices too are seeing significant selling pressure. How have you assessed the earnings season that's gone by, and valuations, are they now more palatable compared to what they were at the start of Q3?
Good morning. So earnings were definitely weak, this quarter for our coverage universe of around 234 stocks, which we cover. We saw earning downgrades to the extent of 2 to 3%. This is the third consecutive quarter where we saw earning downgrades. And if you look at, the breadth was quite weak. Only 32% of our coverage universe stocks were able to beat earnings. This was the lowest percentage in last, 3 to 4 years. So clearly, there is pressure on the broader market this quarter. Our coverage universe on mid and small caps actually had weaker earnings than even large caps. And in fact, even large caps had a single digit kind of earning growth of around 8% on a YY basis. So overall, for this entire financial year, FY25, we'll end up with only around 1% earning growth for the coverage universe. But next year is expected to be better at around 16%. But we believe there is still a bit of optimism sitting there, and there are chances of downgrades to FY26 earnings as well to some extent, but still it would be better than FY25. Coming to valuations, market has already discounted the slowdown to a reasonable extent. We were quite bearish on the markets for last 6 to 9 months, especially mid and small caps. We kept calling for a sharp sort of a correction in mid and small cap space, which has happened. A lot of the froth has gone out. I would say that still mid and small cap at an index level are still a bit expensive, and probably for next 6 to 9 months, one should not expect any great returns out there. In fact, there could be one more leg of correction in mid and small caps at some point during the year. But at a Nifty level and large cap level, after this correction of around 13% from the peak, now we are at 19.5 times, 1 year forward, which is essentially very close to the long-term average, 5-year, 10-year average of around 20x. So at a Nifty level, we don't see a huge downside from these levels, but at mid and small cap, there is still some more pain to go. But the good part is a large part of the froth has already gone. So, one can start looking at individual stocks and do bottom-up stock picking.
Okay, bottom-up stock picking is what you're suggesting. Some bit of a froth has gotten out of the mid and small cap. Varun, good morning, and thank you so much for joining in with us. What I want to also know, you said, right, that next year earnings are expected to be better than this year's earnings. Overall, you're expecting that improvement, or specifically large cap would be a bet coming in, given that you've also highlighted that mid and small cap maybe could still see some bit of a correction. So would large cap be your preferred bet, and in that also which sectors?
Yeah, so earnings recovery would happen in both the spaces, but we believe the earnings recovery will also be sharper in large caps compared to mid and small caps. I think mid and small caps will see a bit more sort of impact of this growth moderation in the economy with a slight lag. So possibly Q4 and Q1 will remain weak for mid and small caps, whereas for large caps, you will start seeing, possibly Q3 was the bottom, and from Q4 things will look better. In terms of sectors, if you look at BFSI has been one of our preferred sectors for last 3 to 6 months. We have been gradually reducing our underweight, which we used to run. Now we are neutral on the sector, and especially on large banks, we are actually overweight. It has been holding up well in this correction, given the valuations are quite reasonable, and still growth in the context of the economy, while they have slowed down in terms of credit and deposit growth, it's still reasonably healthy. So large banks is preferred. IT, we are overall not as bullish as what the street is. We have been slightly conservative. We are underweight on IT, but on the large cap IT names, we are still comfortable. So we continue to hold Infi and TCS in our portfolio. But overall, we are not as bullish on IT. Pharma, is again one sector which has been delivering good earnings. In Q3, it was one of the standout sectors in terms of earnings. But again, valuations had run up out there. So we have been reducing our overweight stance in pharma to an extent. Consumer, we are, consumer continues to struggle with, we continue to struggle with valuations out there. While we are more positive on discretionary compared to staples, getting bottom-up ideas is a challenge given very high valuations in both the sides. And industrials, again, valuations has been a challenge. We have been cutting our weight in industrial space for last 1 year, and that continues to be the case. So I think sectorally, there are going to be very few sectors like possibly banks, some of the large IT names where you will see some earnings acceleration in FY26.
Varun, talking about the consumer durable space, so many baskets to pick from. And also very interestingly, Friday marked the 14th straight session where you actually saw the FMCG index decline. Now, in this current fall, also post-budget, do you like any of the names over there?
Yeah, I think, clearly from a government perspective, there is a shift from, being overtly capex oriented in the first 3 to 4 years post-COVID to now being more consumption oriented, which we believe is the right step because I think economy needs a bit more push on the consumption side. In terms of consumption, our view is that while rural has been relatively better, even rural has been, on the weak side. It's just that urban has slowed down much more than rural, and therefore rural is looking better. And the benefit of the tax cuts will also be felt more on the urban side and especially discretionary. So therefore, we prefer discretionary over staples, which is FMCG. But I think FMCG also will have a better FY26 compared to FY25, which was very weak on the demand side. So I think both discretionary and staples from an earnings perspective will do better in FY26. But our picks are more on, on the discretionary side. So some of the names like DMart, Nykaa, where we were on the sidelines and we had a negative rating because of very high valuations, we have upgraded them from reduced to add, so they can be looked at. Some of the staples names we continue to like Dabur and Marico. So they can be looked at for FY26 from the FMCG space. So there are few pockets, but something like jewelry and paints, we are still not fully convinced. So those two segments, we are still underweight. Consumer durables and select EMS players, we are still positive. So Crompton Consumer and Sirma, SGS are our preferred picks out there. So yeah, that's a broad our view on the consumption space.
Okay, thanks so much for that, Varun. So yes, you do not like still jewelry. Paints is not something that is too positive on that front. Consumer durable still looks interesting. Thank you so much, Varun, for joining in with us, giving us the view on the market as well as different sectors and consumption side as well. But on that note, a small programming note for our viewers. CNBC-TV18 and HSBC India are back with Season 2 of SME Champion Awards. This prestigious platform celebrates SME that are pushing boundaries, making an impact and shaping the future. Nominations are now open. Scan the QR code now and submit your entry for SME Champion Awards Season 2.